Nitin Rakesh of Motilal Oswal AMC as well joins in with his thoughts on the market. Nitin, hi, morning. What have you made of all of these volatile moves? Do you expect some more downside in the markets?
Morning. I think we've had a fairly strong correction from the peak, almost 12-odd%. I think market's kind of consolidating right now in the post-correction phase. Clearly, a couple of things have happened. One, we've seen a fair amount of turmoil in the market related to some of the irregularities and the scam issues. So I think quality is back in vogue. Clearly, people are giving a huge premium to names where there is a fairly strong corporate governance and no doubts on the numbers, as Udin was mentioning. So I think that's one thing that clearly will drive the short-term sentiment. And anywhere where there is even a wave of doubt, we'll probably see punishment on the stock front. And secondly, I think even globally, markets have kind of started to take a breather from the correction that we saw. So clearly, I think we're in a phase where markets seem to be consolidating, digesting the volatility that we saw over the last 2 weeks, and looking for fresh cues. And in a couple of weeks from now, we'll start expecting the third quarter numbers. And I think that's really what we need to focus on for the next 4 to 6 weeks.
Morning, Nitin. Banks came off quite sharply yesterday after the big deposit rate hikes from the State Bank of India. There is a concern that maybe margins will get NIMs will get crunched for banks. Do you think PSU banks could underperform in this scenario of deposit rates rising faster than lending rates?
I think, two things. One, obviously the short-term liquidity concerns have obviously forced banks to speed up their deposit rate hikes, because really clearly they're looking to get, fresh mobilizations. But I think the impact on NIMs is not going to be significant, primarily from the point of view that, obviously the banks also expect a very, very strong credit offtake over the next 4 months. And, remember, we are in the busy season right now. So I think there's going to be a fairly swift pass on in terms of hike in lending rates as well. Our view is that this is a great opportunity to continue to build portfolios. We are still looking at expansion of ROAs and ROEs. I don't think this impact will actually trickle down in any major significant way to the NIMs that wasn't expected before. So I think if you're looking at NIM of 3.43 odd for last quarter for SBI, for example, I don't think we can expect more than a 5 to 7 basis point, at max 10 basis point hit to that. But that's, I think, already in the prices. So from here on, and we've always been buy on dips from a banking perspective over the last year and a half or so. And I think that strategy seems to actually have some more steam left. Clearly, there is a little bit of hangover from the housing issues that we saw over the last couple of weeks. But I think all said and done, this is a great opportunity to continue to buy into the PSU space and the overall banking space per se.
So within the banking space then, if you had to skew your portfolio, would it be more towards the PSU banking lot, or would it be towards the high quality private bankings, the likes of HDFC Bank, ICICI Bank, even in the mid-cap space?
I think a combination of both is ideal, but clearly, there seems to be a little bit of discount on the PSU space given what's happened over the last couple of weeks. And at this point in time, I think there is more value in PSUs. And if you have to bet on the expansion of ROAs and ROEs, then I think the PSU space actually gives you a lot more scope for expansion on those fronts as well.
Nitin, the big worry for now has been the way crude has been rising. What kind of ramifications would it have in our market, specifically in spaces like the OMCs?
I think, that's a very valid concern. We've obviously always had one eye on the global crude prices. I think the place that we are in right now is that, one, there isn't enough clarity on how the subsidy sharing is going to work. So, between upstream, downstream and OMCs. So one has to assume potentially an equal split between the three. So clearly, I think that puts a little bit of pressure, but eventually it's all going to go through government finances, because they're not going to issue any oil bonds, as per their stated policy. So that clearly puts a little bit of a shadow on the oil and gas space. Higher crude prices means, effectively subsidy burden, and lower prices anyways put pressure on the margin, refining margin. So I think they're in a no man's land right now. We need a little more clarity on maybe the dismantling of the APM for diesel, some more roadmap for gas, and potentially how the subsidy will work in the interim before a view can be taken on those. But I think clearly something that will get uncomfortable if crude continues to inch up closer to 100.
Nitin, where do you stand on commodities? Do you think all this talk of more quantitative easing, etc., could see in the commodities outperform in the near term? Are you backing any of those names?
I think clearly the short-term impact we saw yesterday was thanks to increase in QE2, or whether it is, I don't know if it's going to be QE3 now, but clearly it's a bet on currency, liquidity, and obviously what happens in the global macroeconomy. Again, going back to kind of brass tacks, I think it's a better idea to stay focused on the domestic sectors from an investment point of view, just so because there are so many more variables on the commodity front that it's kind of very hard to take a call. But I think it looks like that we are in for a period of at least a trading zone where the commodities might do well over the next few weeks and months.